Hello and welcome to today's webinar, Data Science and Asset Management. My name is Mark Salter. I'm the Executive Director for CFA Society Minnesota, and I have the honor of kicking things off today by thanking our co-hosts from up north, the Canadian Association of Alternative Strategies and Assets, and the Forum of Investment Alternatives in Montreal. Also want to thank my friends at the CFA Societies of Atlanta, North Carolina, Philadelphia, San Francisco, and Washington, D.C., and a special thank you to San Francisco for extending the use of their webinar platform to make room for all of us today. I also need to thank our event partners, Kaplan Schweizer and FDP Institute, and especially FDP's Executive Director, Mirzad Mahdavi, for his good work helping us create a unique two-pronged deep dive into our subject matter today and recruiting some of the industry's best thought leaders along the way. To frame today's session, I'd like to turn things over to Bill Kelly from the CAIA Association for some opening remarks. Bill has served as president and CEO of the CAIA Association since 2014. His career in the institutional asset management industry spans more than 30 years through successive CFO, COO, and CEO roles, including serving as CEO of Boston Partners. He is a frequent industry speaker, writer, and commentator, and a tireless advocate for shareholder protection and investor education. Ladies and gentlemen, Bill Kelly. Bill, take it away.
Thank you, Mark, and certainly thank you for the partnership and the introduction. And I was really taken by that first slide about the amount of partners that got together to put this event on. And it really does take a village. We're trying to serve global investors for better outcomes in a period of unprecedented change. So I welcome and support the partnership and friendship from all of you. So thank you for that. This concept of data science and asset management is not necessarily a new term, but the pace of change and the acceleration continues to move at a pace that is really unlike anything I've seen in the 40 years I've been in this industry. And it's an honor to be sitting in front of some very great minds, people I've known since the very early days of CAIA, folks that sit on our advisory board, and also some of the folks behind the founding of our FDP Institute, as well as I said, the CFA partnerships. And there are two maybe things I want to hammer home as I turn this over to the practitioners who have the content and the subject matter expertise. And there's two constituencies which we always have to be cognizant of, and they may not be necessarily represented in the room today, but they're first of mind, top of mind. And here I'm talking about the regulator and the client. And starting with the regulator, there was a very interesting enforcement action that happened just about a month ago that didn't necessarily get the press it deserved. There was a alt data provider called App Annie, probably not regulated by the SEC, and SEC enforcement was probably not tucked in the risk register. And then wake up one day and the SEC is knocking on their door with an enforcement action and comes bearing the gift of a $10 million fine, $300,000 for the CEO. And they must have hired a very good SEC attorney because they came up with they were not going to admit or deny any guilt, and they paid the fine and they moved on. But it is an important signpost. So here you got an old data provider who's not using any kind of differential privacy, not regulated by the SEC, and yet they went after them because they were getting access to this data, selling it into our industry in ways that should not have been done, and the SEC went to the beginning of that pipe. So it's a very big wake-up call for anybody running an asset management business or anybody in a CCO role that the rules of engagement are changing. The SEC is looking at this quite closely. They may codify regulation through enforcement, which is a horrible outcome for you practitioners out there. So be aware of these changes and always think about what is on the client mind first and foremost, which leads me to the other constituency, which is the client. The pace of change, and I think in the second part of today, when we talk about opportunities and challenges, we're going to be covering some of the changes in the front, middle, and back office, and this concept of operational alpha as an example. And the cost of doing business is going down. The pace of change is enormous. And as I said, I've been in this industry 40 years, and it's interesting to see that the DTCC is recently talking about trade date +1, which is almost comical. And as a result of that, I looked to see how long it took us to get from trade date +3 to trade date +2 for a garden variety equity security. It took us 24 years just to get to T+2. And now you have the DTCC saying a couple of years from now, we'll get to trade date +1. We have the infrastructure in the middle and back office with security tokens to really have trade settlement in a nanosecond using distributed ledger. Regulation needs to get there, but things are moving at such a pace that I suspect that this is going to be real and it's going to be at our doorstep in the not too distant future. But when it comes to concepts like a security token, which is today's and tomorrow's stock certificate, what do? We allow the narrative to be seized by an artist called Beeple through a non-fungible token sold for $69 billion at Sotheby's earlier this year. And if you want to go and look up that B20 security token, I checked at noon today, you could get it for 87 cents. So we cannot use these tools as more sophisticated and faster ways to lose investors' money. We've got to use them for bringing greater operational alpha, greater efficiency, and de-risk an investment process. So I think that is all about what today is. We're going to be talking about some practical applications around the use, and then the second panel is going to be talking about the opportunities and challenges. And I encourage this very large audience we have here today to think throughout, what does the client think? What does the regulator think? And if we look at it through that lens, we're going to come up with the right solutions. So with that, I'm going to turn it over to Don Hejna, who I don't have your bio in front of me, but given your credentials and partnership or friendship over many years, you're a hell of a lot smarter than I am. And it's great to have you following on from me. And I'll turn it over to you to continue on the discussion.
Thank you, Bill. Yeah, it's an honor. It's an honor to follow you. I appreciate the introduction. Welcome, everyone. This is an exciting webinar version of an event that was initially planned for the summer and in Minnesota. So I'm actually excited that we're able to get so many societies from across the country involved here and candidates from, attendees from everywhere. Quick word about today's format. Well, I'll get my screen up. We have 3 speakers in this section of the presentation, which will last about an hour. And following this, we have the industry professional panel, which I want to make sure I mentioned will take place after a short intermission. And please, I encourage you to stay for that. You're going to hear from leaders in the field on how they're incorporating data science and artificial intelligence. I'll open our session by introducing a few other speakers. Again, my name's Don Hejna. I'm a CFA charter holder, a CAIA charter holder, and an FTP charter holder. I love all 3 like children, and I would encourage you, if you have any desire to pursue a charter, that you get started today. It's a process and it's well worth it. As I get my screen up, I will, let's see. I will start with, I'll turn over to Cordell and Lucas for a short introduction while I get my screen up, and then we'll take it from there.
Sure, thank you. Don, I'm assuming you can hear me?
Yes. Great.
So hi, everyone. My name is Cordell Tanny, born and raised Montrealer. Been in the business now for over 20 years after having graduated McGill University with a degree in molecular biology. Majority of my career was spent with Standard Life and Standard Life Investments. My expertise is in quantitative finance, so I had worked on asset allocation products there, really focusing on portfolio construction, optimization, manager due diligence, and now really developed a specialization in machine learning and AI as applied to asset management.
And Lucas, if you want to say a brief word, and then we'll turn it over back to Cordell to start us off.
Yeah, thanks, Don. Yeah, my name is Lucas Bunting. I'm also a CFA charter holder like many of you out there. And I spent a good chunk of years at an asset management company doing both fundamental and quantitative research, kind of fell in love with the quantitative stuff. And that led me down a path to machine learning and AI, and kind of look forward to walking through you guys a few things from what I've learned over that time period. So back to you.
Thank you. So hopefully you can see my screen here. I'll just do a quick fast forward so that we can outline things today. we're going to start with basically 3 chapters. Customizing tools in Python for manager style analysis will kick us off. We'll talk about driving commercial tools and data for investment performance gains. And I'll close out the session with a few examples of leveraging the power of R and open source tools for financial analysis, and then talk a little bit about some gains from alternative data based on a paper that was published that I think is very interesting. So with that, I will stop sharing, turn it over to you, Cordell, to kick us off, and look forward to hearing what you have to say.
Great, thank you. So let me just share my screen. Don, just give me a shout when everything is up. All right, let me know when you can see my screen, please.
We see your screen. You're ready to go. Thank you.
All right, thank you. So the title of my presentation today is Data Science and Machine Learning in Manager Selection and Portfolio Construction. So really what I want to get done here today, I have 3 objectives. The first one is to demonstrate that not every data science project out there has to be a massive endeavor requiring investment in infrastructure with AWS, Azure, hiring lots of PhD students. There are plenty of smaller scale projects that anyone can do and incorporate into your daily workflow. My second objective is just to really show how powerful Python is and what you can accomplish sometimes with just a few lines of code, especially for what we call exploratory data analysis, or EDA, when you really dive into your data, visualize it, and really get a deep dive into the analysis. And my third objective will be to demonstrate how a hierarchical clustering algorithm, and I promise you I will explain exactly what that means, how this can be used to help your manager due diligence and portfolio construction. So those are my 3 objectives. I hope that works for everyone. So let's start with, the first step of any data science project is to, well, what are you trying to do? What is your business need? That is always the first step that you want to do. And, what are you trying to accomplish? Do you have the resources necessary to do it? And of course, do you have the data? The data is very important. So in this case, what am I trying to do here? So the question that I'm going to ask everyone right now is, can I combine managers, correlated managers, in a way that actually increases portfolio diversification, right? More specifically, what I'm asking or trying to do here is, can I find managers that are in the same category, that are in the same universe? They're trying to beat the same benchmark, but potentially trying to do so by using different strategies. Can that offer me a diversification benefit? Can I get something from my portfolio construction by combining managers that are otherwise correlated, but do things very differently? So why am I trying to do this? I'll just provide a little bit of context here, right? Anyone out there that's done any form of portfolio construction, portfolio optimization, knows that we rely very heavily on 3 inputs. Those inputs are returns, a risk measure, and correlations. Now, the issue that I have here with correlations is that they can be extremely unstable. They are subject to estimation error. They might not tell you everything that's going on within your data set. And then you got to factor in, okay, am I just taking a point in time estimate of a correlation? Am I going to take an average of a 3, 5, 10 year? So, there's plenty of techniques out there to deal with these issues that we have with correlations, shrinking the covariance matrix. But I want to see if I can get away with correlation. I want to see if there's something that I can do that can bring me, a way to find managers, how they can be fitting together without having to rely on correlations. So the next step of a data science project here is to explore your data. So you're going to hear this term exploratory data analysis quite often from data scientists, for short EDA. So what we're trying to do here is really understand what's going on inside our data, the relationships underlying it. And you're typically dealing with high dimensional data sets, which makes it a little bit more complicated. And I promise you, there will always be shortcuts. There is no such thing as a clean data set. It will always involve some kind of cleaning, massaging to get it ready for your machine learning algorithm. So what is the data that we're looking at here? Well, I'm doing manager due diligence, manager selection. So I'm concerned with manager characteristics over time, all right? And what I'm hoping here is that EDA is going to help me identify and confirm a manager's strategy. So we're going to be dealing with the Canadian fixed income universe today. And of course, just as an example, what do I mean by a manager's strategy within Canadian fixed income? Well, you could have a duration manager. Some managers trying to manage the duration aspect of a bond portfolio, which is the measure of interest rate risk. Or you could have a sector allocator, someone who's going to overweight governments versus corporates or get into more MBSs. So, there's different strategies that a manager could have while playing in that same sandbox. So what I've done here is I had to retrieve time series data for all of the features. Okay, so features here, I'm going to be using that instead of the word characteristics. Why? Because feature is the data science term. So I got all the data that I needed for all of my features, and I will walk you through the features. And as I said, the preparing your data really will be the most complicated and longest step of almost every machine learning problem. Why? Just to give you some potential problems that I've dealt with: missing data. Right? You might not every manager might have data. You might be missing a couple months here and there. It could be different reporting frequencies, right? So anyone familiar with Morningstar Direct will see that some managers will report monthly, some will report quarterly. And then of course you might deal with funds that have an insufficient history, and you'll have to make the decision whether or not to include them in the analysis. And it's very important to note here that Python and R have so many built-in functions to help with this, right? It really makes your life easy in so many different ways. So I'm gonna switch over to the app that I created for this. Before I do so, I just want you to know that everything you are about to see, I created in Python with their associated packages. They are all open source, all free. And the manager data that I used for this has come from a commercially available data source. All right, so I'm just going to move over to the application. All right, so what you're seeing here, I built in Python using some multiple packages, notably Plotly and Dash. There is zero web design that went into this. It's not necessary. A lot of that back end and front end is built into the Plotly and Dash packages. So as I said, we're going to be dealing with the Canadian fixed income category. So just as a way of some background here, the Canadian fixed income, the core Canadian bond category, right, is an asset class that every Canadian portfolio, whether retail or institutional, is going to have a sleeve. It's going to have a spot in the model. So the idea here is that all of these managers inside this category, they're pretty much trying to beat the benchmark of the FTSE Canada Universe, which is the equivalent of the Bloomberg Barclays Ag in the United States. So this benchmark is about a 70% government bond, 30% corporate bond index with a duration that typically stays around 7 to 8. So what I've done here is I've just preloaded in 10 of the largest core Canadian fixed income funds into my drop-down box here, so you didn't have to watch me do it. So now what I'm going to do is, I'm trying to explore the features. I'm trying to explore these manager characteristics, their management styles, and what they've looked like over time. So I've selected 15 features here that I think describe a fixed income manager, their exposures, and their strategy. So I have government bonds, corporate, I put cash, there's securitized securities, of course, some geographical distributions in here, duration, number of bond holdings, and then of course we need the percentage that they're going to have in each of the credit quality buckets, right? So let's just start with a simple one right now. I'm just going to take the government bond. So immediately, I'll make this a little bit bigger so everyone can see this. All right, so here is the distribution of 10 funds over the past 12 years within their government allocation. So we can clearly see here of our 10 managers here, we've got managers that are doing different things, right? We have one manager here that went as low as 0, whereas others that have been a little bit more concentrated, down here in the gold, have been much more focused. So right away, I'm getting a sense for a manager's strategy. And let's say they tell me we are sector allocators, right? And I would expect to see a graph like, somewhere in the green, the red, or the purple. I would expect to see a massive change between their percentage allocation if they're telling me they're sector allocators, right? And this plot, this is called a swarm plot. And I love this graph because it allows me to see the distribution in a way that a box plot, I can't necessarily see it. And at the same time, it's also independent of time. I don't necessarily want to see this as a time series. I might in a different kind of analysis. But when I'm trying to visualize 10 managers at once, this plot does a great job for me to analyze the distribution of a feature over time. I could pull out another one here. Here's corporate bonds. I expect this to be somewhat of a mirror image, given that the primary sector allocation here will be between government and corporations. I can take another one here. We can take Canada. This is a Canadian category. I wouldn't expect my managers to be too far in the US, but right away, I do see a fund here that is very tactical with their geographic allocation where everybody else isn't. So you could use this to help you say, well, look, what exactly am I after here? I'm looking for a Canadian bond manager. Am I willing to accept a manager that will go this far away from Canada? Maybe yes, maybe no. There's no good or bad here. It's just all a matter of satisfying the parameters of your search. And then, of course, you can take, duration is always a very popular one. So the whole point that I want you to get out of this, though, is I'm looking at 4 features here, only for 10 funds. I need to analyze 15 features across 60 funds. Now, I don't know about everyone else out there, but my limited human brain cannot compute the pairwise distances and similarities of 50 funds across 15 dimensions. So this is the perfect setup for a machine learning problem. And this is where machine learning comes into it. So I'm going to flip back to my PowerPoint here. So again, what am I trying to do here? I'm trying to find the similarities or differences for 60 funds across 15 dimensions in hopes of trying to find a couple that will fit well together in a portfolio, right? So this is perfect for a machine learning algorithm, but which one, right? I've got to decide which machine learning algorithm will address what I'm trying to solve here in my business. So I'm just going to take 30 seconds, just give a very quick explanation of the main classification that we have for machine learning. So we tend to divide it into 2 types of algorithms, supervised or unsupervised. So most people are familiar with supervised learning, like linear regression. We have a series of X variables, which we call features, and we have a Y variable, which we call a target. We are trying to predict the target through the features. We typically use this to make predictions, inferences, to understand the relationships between our features. And we can do this as categorical or continuous variable. What this means is we don't always have to predict a quantity, right? So that would be a continuous variable. We also have categorical variables. For example, we can build a model that will predict whether or not the market will go up or down tomorrow. That's an example of a categorical variable. Some examples here that people are usually familiar with are random forest, gradient boosting, and artificial neural networks or deep learning models. On the right-hand side here, what we have are unsupervised learning methods. Here we have features, but no targets, okay? That means that we have only X variables, no Y variables, and what we're trying to do here is to identify patterns within unlabeled data. And this is what is used for a cluster analysis, where the prime examples here are hierarchical clustering and k-means cluster analysis. So as you can see here, we're dealing with unlabeled data. We do not have a target. I am trying to find patterns and similarities within my unlabeled data set. So this is a clustering problem. And hierarchical clustering is the algorithm that will work very well here. So as we get into this, I'll just do a very brief recap. What are we doing? We've got 15 dimensions, 15 features over a 12-year period for over 50 funds. All right. So we're using the unsupervised learning method here to try and find the similarities and differences between different managers based on how they've their exposures to these different 15 features. So I'm going to jump right back in over here. So I'm going to switch to the clustering tab over here. First thing I'm going to do is I'm going to run the algorithm. Sorry, this takes about maybe 5 seconds to run the algorithm. It doesn't take long. All right, so this is the main output, what you see from a hierarchical clustering algorithm. It looks complicated. I'm going to explain everything about it. So as you can see, it's got this tree-like structure. We're at the bottom here at the 0 on the y-axis. Every fund that we're looking at represents its own cluster. As we move up the hierarchy, we're going to get fewer and fewer clusters with more and more funds within those clusters, right? So we're going to start seeing as the, at the bottom here, everybody is somewhat different. As we move up, we're trying to group them by their similarity. So there's a distance being calculated between each one of these points, right? So the way you want to read this graph, right, So once you start seeing these big vertical lines, that means the distance between the clusters is getting pretty big. So right away, when you see these two large vertical lines, this means this, like the red and the blue are pretty far away from the green and the purple. So the green and the purple are probably doing something very different than everybody else in this category. And you see how much is in the red, which kind of, I find this intuitive. You know, when you're dealing with a Morningstar category, you would sort of expect that there's a big part of that category that's going to be doing something somewhat the same way. And maybe there's a few players doing something different. So the way to choose how many clusters you want is you just draw a horizontal line somewhere. And every time you cross a vertical line is where you get a cluster. So I drew it around 12 because to me, that's where I see the structure. I see the blue, I see the red, I see the green, I see the purple. So in theory, I can take a fund from the blue, combine it from a fund from the purple, and I should be getting a diversification benefit here because I've got managers doing different things, even though they're playing in the same sandbox. So my analogy here is you've got people in the same sandbox, building the same sandcastle, but using different equipment. So this is great. But you know what? It still suffers from a small problem here. It's like interpretability, right? There still is an interpretability issue here. And as I said before, I can't picture 15 dimensions, you know, on a graph. Wouldn't it be cool if there's a way that we can do it? And we actually can. So there's something here called a TSNE visualization. The TSNE stands for T-distributed simulated neighbor embedding. And the reason why I know that is because I wrote that down on a Post-it note over here, which is conveniently outside the camera angle. So if I click on our chart here, now I have flattened down our 15 dimensions to 2D, right? And the colors correspond to the same clusters you saw on the dendrogram. So now I could hover over here. I can see which manager is which, right? I can actually see the distances a lot more clearly, and I can see which funds go next to which ones. And I can even clean it up a little bit. I can, let's say, take out cluster 2. And okay, now I can really get a sense for the distances between each of these ones right now and realize how different my blue, green, and purple are. So I love this kind of visualization, again, because it gives me a different way to look at my 15 dimensions in a two-dimensional space. Don't worry about the units on the X and Y axes. They're actually meaningless. So this is great. Let's take it one step further. What if I wanted you to just say, or I wanted to tell you, I want to pick a fund and you tell me which funds are closest and which ones are furthest away. So I'm going to pick a fund. I'll take one from Dynamic for no particular reason other than that's the company I work for. So that's it. One click of a button. I now know which managers in my universe are closest to this fund and which ones are furthest away. All right. The numbers here don't imply rank. They don't imply good or bad. This is just a standardized distance measure, right? So this is telling me that Sun Life Multi-Strategy Bond is the closest manager in terms of how they've managed those 15 features, their distribution across those 15 features, how close they are to my current fund. So if I'm looking for diversification benefits, I might want to look at one of these 5 over here, right? I can go back to my EDA, my exploratory data analysis here. I can start pulling up all of these funds and, you know, start looking at those features. Where are they? Maybe they shouldn't even be in this universe, right? Maybe they're doing something so different than everybody else that that's not really what I'm looking for in terms of my target exposures for the fixed income manager question, right? So I love this. I just found, like, you know, we found a way to drill down from the dendrogram to the TSNE and then just to doing an outright search. So I'm just going to switch back to my PowerPoint. All right, just to close this off, what have we accomplished here, right? Well, first off, by using that dendrogram, I've actually uncovered the substructure within a Morningstar category, right? I can clearly see now the distribution within that category. I used also the dendrogram and the TSNE to find managers in different clusters, right? That could potentially offer me the diversification benefits that I'm looking for. I've also discovered a method to complement optimization. You can't do this with portfolio optimization. If you're focused on correlations, 2 managers in the same Morningstar category are inevitably going to be highly correlated. And lastly, we saw how EDA, the exploratory data analysis, can be used to analyze our features. And look, this would be so near impossible or time consuming to do in Excel. And it just shows how powerful Python really, really is. So I'm just going to come back to close with my objectives. So what were my objectives here today? I wanted to demonstrate that not every data science project had to be some massive endeavor with people, infrastructure, small scale projects that anyone could take, that you could work into your daily workflow. Second was just really the power of Python and what you can do for visualization and analysis. And lastly, how I used a hierarchical clustering algorithm to help me in my manager due diligence search and potentially with portfolio construction. So those were my objectives today. I sincerely hope I accomplished that. And I will now turn it over to Lucas for his presentation.
And Lucas, while you're getting ready, I just want to tell the attendees, we'll have Q&A at the end, and we're seeing some great questions. Cordell, you might take a look at those as well. So at the end of our 3 sessions, we'll have time for Q&A, and we'll work through all the questions. Thank you.
Sure.
Great, thanks, Don. Can you see my screen all right?
Yes.
Wonderful. Okay, cool. So hi, everyone, and thanks to Cordell for making me have to follow that. But my name is Lucas, and you know, I was previously the only quant at an asset management company and used auto machine learning tools, or auto ML tools that we'll talk about, to carry out the model building process of several problems related to both fundamental and quantitative research. So, you know, Cordell did a great job explaining how an unsupervised machine learning algorithm can be applied to the manager due diligence process with some free tools, some time and coding experience. That was just him in Python creating an application that suited his needs. There was no extra software. I'm going to pivot that discussion a little bit and show you how a supervised learning algorithm applied to the security selection process can be done in a slightly different manner with a few more tools, but a lot less knowledge around coding. And so I've met with several small fundamental asset managers and larger RIAs who have expressed interest in data science, and they kind of share this similar sentiment. They don't have the coding expertise or data science skills in-house, and it might be too costly for them to acquire them without really knowing if it's going to be impactful to their process. So my job here is not so much to prove to you what Cordell did, that machine learning is better than traditional models, though I might suggest that, as it is really to show you that a single person in your firm can build, train, test, and deploy machine learning models without any code, but using commercially available tools and data sets. So we're going to take a look at some automated machine learning software in just a little bit. But before I do that, I just wanted to provide you with the context of our problem. We're going to use AutoML to generate a prediction that assists the fundamental research process of picking stocks. And that prediction is going to be a 1 quarter ahead idiosyncratic risk, or the company specific risk. And it can be used outright for volatility weighting, or risk-adjusted returns optimization, or, you know, if your portfolio managers tend to be a little bit more hands-on and would like it more as like a data point to supplement the other ones that they monitor, it can be presented like that too. The way that I'm defining idiosyncratic risk is kind of based off of this disaggregation of tracking error into a systematic component and an idiosyncratic component. And, you know, I claim here that holding higher idiosyncratic risk names in your portfolio, subject to the due diligence of your investment process, will tend to give you a higher probability of beating the market when you know which names are going to have a higher idiosyncratic risk in the future. So we kind of understand this target variable. So I'm going to briefly walk through feature engineering because Cordell touched on it pretty well here. Adding features or variables to your model is the most important step in this entire process. It's the best opportunity for people like us with investment backgrounds to impart our domain knowledge to the algorithm. And for this example, I use several types of features, you know, some from fundamentals, some valuation metrics, pulled a few features out of the options market data, but this is just This is just data that I'm pulling out of FactSet, and it's all commercially available. And you massage it a little bit, but that's it. And so once you have your features and they make intuitive sense to you, you have your target variable. Then you get to play with the fun part, and that's the auto machine learning tool. Now, typically when you get to this point in your pipeline, you'd be staring down the barrel of choosing a single algorithm out of dozens, and then choosing various permutations of those algorithms based on your data or your use case. And then you'll have to train and test each of these algorithms to see how it actually performs. And for a single person, that process can take weeks or months, or even more, depending on what it is. Fortunately, several companies have created tools that not only automate a good chunk of this process, but also provide some default rules of thumbs or heuristics to guide the investment practitioner down the right path. And I kind of like to think of this as honestly the like doing some Wii bowling with some bumpers. And the bumpers are those heuristics that people smarter than me have kind of figured out, and some intelligent pre-processing that really scales up that part of the pipeline. And the Wii part is the lower amount of exertion on your team that you'll actually need, given the automation and the parallel computation capabilities of a lot of these tools. But it's not without its faults. The primary concern is that you're not going to look nearly as cool at cocktail parties as if you're, Don or Cordell doing a lot of the sexy coding in the background. But I maintain the average practitioner will be able to create much better models than they would without the tool, much like the higher score you'll probably get with bumpers and Wii bowling versus kind of your high score in real life. So we have our data, we have our target, we have our features, and so now we actually kind of get to play with this tool a little bit. And so what I'm using is Data Robot and FactSet, but there are tons of other tools that you can use. So you have your data and you've sent it into this software, okay? Once the data set is loaded, we just have to specify how we like the model to be trained. We choose our target variable, so that's, I label it as target, and here's the idiosyncratic risk. It identifies it as a regression problem, that's great. And then all I'm gonna do is set up the cross-validation, and that's just how you train in blue and then test in green the model. It does it over different time periods. And it kind of helps you prevent overfitting while training over different time periods, which is important in finance. So once you do that, you get to press this really big button up here. I don't know if all of them have buttons, but that sometimes they're pretty fun to make. And then based off of the number of features you have, how long the data set is, and a few other things, it may take only 30 minutes or an hour. Sometimes it takes a whole afternoon. Sometimes they run these overnight. But what it does is it generates a whole bunch of models. And in this case, it was 65 models. It generates 65 models. And they're not all different models, but they have different sort of default settings. And then it ranks them from the best on the top here, accuracy-wise, and this is by RMSE, but don't worry about that. It ranks it accuracy-wise from the best to the worst. And so it's a very powerful leaderboard that makes it pretty intuitive which models you should start investigating first. And this is really quite valuable because a ton of time can be sunk into generating a bunch of models. And the performance delta can actually be quite small between a few of them, like this gradient boosted trees and this XGBoost model here. These perform pretty much the same, but you would have spent a good chunk of time developing both of them. So it's really nice to have that all automated for you. But let's focus on some models. And I standardized and transformed and centered this data so that we could make a feasible comparison to classical linear approaches. And so we can see if an ML model actually helped. And you can see that they certainly did. These are all machine learning models. And the first one that you see that is a linear model is halfway down this list. And I did us all a solid here and just went ahead and started the best linear model down here. And it is significantly 0.8863 on all back tests against 0.58. Lower number is better. So all of these machine learning models did tend to do better than the linear model that was here. So, okay, this is a machine learning problem. I got to take advantage of some machine learning tools. Fantastic. So let's go ahead and dive in a little bit here and take a look at a specific model. And so we have our categorical variables, we have our numeric variables, and our text variables. And you can see that the system already intelligently transformed those variables so that it can be input into the model. We didn't have to do that. But I always like to look up here and make sure that these got transformed in a way that it was intuitive and made sense. So there's a little bit of know-how there, and that's something that you can easily learn. I guarantee you'll take a fraction of the time that you spent studying for level 2. And then when you're cool with how the pre-processing went, then you can sit here and you can evaluate your model very easily. This is a lift chart. What you want is an upward sloping line like we can see right here. You want the blue and the orange lines to be very similar, and you kind of get kind of bonus points in this model for it kind of having the wing at the end too. So it isn't rocket science to analyze the performance of these models, and this one does suggest that this actually predicts it quite well. Another important thing that I like to look at is the feature fit, and this will show how these features are correlated with the actual target variable, and here's implied volatility. And if we're trying to figure out idiosyncratic risk, yeah, well, that kind of makes sense. But let's look at next 12 months PE, and we find a U shape here. And I point this out because linear models want to draw a line through this association, but there is clearly structure here, right? On one end, you have the more volatile high PE stocks, and on the other, you got actually volatile deep value stocks, and that makes intuitive sense to an investment practitioner. Mapping that relationship correctly is important in making an accurate model and gives the advantage to tree-based models like this one over the linear models. The last thing I'm going to show you here today is the feature impact here. And I really like that because it's just a stack rank of the importance of each feature to this model. It's a good gut check. And here's really a quick sidebar on the application of machine learning. While the primary purpose of it is really to generate predictions, I don't think that's really its sole purpose in finance. Just like using linear regression for returns-based holding analysis of like active funds and ETFs for, to check style tilts or whatever, or what have you. You can actually use an XGBoost model as a research tool to help you figure out key nonlinear components that drive whatever target variable you're looking for. And I think, a screen like this can be really, really powerful, even if the end goal isn't to deploy a machine learning model. Speaking of which, if you do want to deploy it, I use Data Robot and FactSet. You definitely don't have to, but when you have a good partnership like that, they tend to make some really difficult things really trivial. Like all you have to do is deploy it, and you click this button, you get a code, and you can put it into your screening tool and go from there. A lot of other AutoML tools will have either like a web-based portal for you to go out and get your predictions, but a lot will tend to ask you to use like an API for your distribution, which means you'll need a little bit of coding expertise, so that is outside the scope of our project here today. So, for those of you that are still awake out there, let me summarize my ramblings a little bit with a few key takeaways here. So, without any programming knowledge, whatsoever, you can train, test, and deploy machine learning models. You'll need some commercial software, but you can predict variables that have nonlinear relationships that are relevant to your research. ML models also tend to have an advantage over traditional linear models when trained on financial data because of the characteristics of financial data. And finally, between Cordell and I, you've seen both an unsupervised and supervised model example, and they both can be useful in your investment decision-making process today. So with that, I will now pass it back to Don, who is anchoring our series on the practical uses of data science and asset management. I do want to thank you for listening to me. So let me get back there for you.
Thank you, Lucas. That was a great example, and it shows that you don't have to be a programmer to make use of a lot of great tools in data science. Now I'm going to transition to the third chapter. I'll start by sharing my screen, and what I want to focus on here is the ability of people to use R to generate useful, actionable items. I want to make sure, can people see my screen with a single slide right now?
Yes.
Okay, excellent. And one other thing, let's see, if I click on this, we're not seeing the laser pointer. Give me a second. All right, how about, can people see a laser pointer here or not yet?
Not yet.
How about now?
Yeah.
Okay, excellent. So again, my name's Don Hejna. I want to start by saying I started out in a very technical capacity in my career. I programmed in many languages. I've used Python, I've used R. And I'll start just to answer a question that often comes up. Should I learn Python? Should I learn R? What's the difference? And I'd say that Python is very production oriented. A lot of people use it. AWS, it's sort of the de facto standard. R is often used a little more by academics. And so for certain things that you're looking to do in a research area, R has some advantage only in the sense that people contribute a lot of their academic research to that or a little bit earlier than it might come out in Python. So more for experimentation and research. So my objective today is to demonstrate that there's tremendous analytical value that can be created using free and open source tools. I'll show you some code. I'll show you the output. I want to show you how powerful R is for analysis and visualization, and demonstrate how data science is creating some edge for those applying it to certain retailers. In the last half here, I'll discuss some of the ethics of have and have not data sets, and where is Mr. Market? How is some of this pricing being missed in this example? So one of the first things investment professionals and everyone should be doing is optimizing their portfolio. Basically, a mean variance portfolio optimization combines stocks in a way with weighting so that you have the maximum return possible for the lowest risk taken. If you're not familiar with this, it's not essential to the presentation, but basically this curve is the efficient frontier. And with giving R just a list of stocks and some stock prices, it can create that series of weightings for you. This is a chart. Again, this chart was created in R with the F portfolio package. There's a link down here in the slides for a great tutorial. And I'll also provide some code later on here to give an example. So let's try this at home using R for free with free stock data. This is the script that gets you stock data and plots performance. I don't want to go through all of this together, but I just want to point a few things out. You basically create a symbol, a list of the symbols. Get symbol goes to Yahoo, does all the work for you, fetches the data from this time period. There's a little bit of work to massage it into a data frame taking place here. And then this single command chart performance summary gives us this chart, which is showing for these ETFs, the various performance from 2004 on. So we have the crash here. This chart at the bottom is a drawdown chart, and it shows you based on the last peak of the stock, how far the price has gone down. So if you look at XLE here, I want to focus on this for a second. You can see here we had a peak, and then down here you'll see this constant sort of downward trend where the stock price moved lower than that peak, bottoming out here around the turn of 2020. So there's 6 months between this. So let's keep that in mind, this beginning of 2020 when the XLE began to lift off and things reopened. Now, to compare the performance of this mean variance optimized portfolio of these assets with an equal weight benchmark, we'll create the equal weight benchmark. And in R, this is a very simple thing to do. You create a vector of essentially the weights for the stock, use that in the list of the stocks that you have with the stock data we fetched, and it'll calculate the return of the portfolio, basically incrementally back testing that portfolio over the period. And so that's our benchmark, and you'll see here we're just saving that in this this reference benchmark variable. Now I'm going to talk about the portfolio constraints. I'll go through this real quick, but basically you set up a list of objectives for the portfolio. You can add some constraints like the maximum number of long and short positions if you want to do that. In this case, we're going long only. And you can put some percentages here called box constraints. So hold at least 5% of each asset and no more than 50%. And when you put all those together, you can run this optimization in a single line of our code. It's a fussy line, and I just want to point out to people, you might wonder, why is programming difficult? Why does it take so long? And the answer is, there aren't always great error messages. So I spent a long time catching a typo in the optimizer name that was passed to it. And thus my quote, R, I love you, but we need to talk. I think the tool could be made better, and it's always getting improved, but just bear in mind, you'll need some patience for some of these more subtle bugs if you encounter them. But here's the result of this optimization. We see a rolling list over time of the weights that give us that optimized portfolio. And in green here, I'm showing the XLE. And I talked about this earlier, and I want to point out that during that long downturn period, you see that the portfolio is basically holding the minimum 5% that we gave it as a constraint. And then starting around the beginning of 2020, when we saw that uplift, you'll see that it's actually increasing the allocation to that particular ETF. And so when we compute the portfolio returns comparing our equal weighted benchmark and the mean variance optimized benchmark, with a single command here, we've built this data frame with the two approaches and the backtest results. You can see we have a great uplift in the annualized return. Basically, it's improved by about 66% from essentially 9% to almost 15%. The standard deviation, which is a metric of the risk in the portfolio, has actually gone down slightly. And the annualized Sharpe ratio, which is the ratio of those two, has gone up about 70%. So this costs zero money, a few pennies of electricity. It's something you can do it at home if you're careful about reading some of the vignettes in R. And it's actually very useful. Now, a lot of professionals will tell you, don't trade on the simple correlation data that you get by looking at stock prices. And there's some truth to that. But rather than just sort of naively picking and choosing weights in your portfolio, you may want to run something like this. And I would encourage you to learn and explore that. So let's look graphically for a second. This again is a single command in R that charts the performance between these two approaches over a back-tested interval. And you can see the red line here, which is our optimized portfolio, has better performance with less risk to get it. It's a win-win in this case. And during most of the downturns, not all, you see that the optimized portfolio held its value slightly higher. In other words, the red line is above the black line in many of these cases. So that's a quick tour of what can be done with R and open source tools, and scraping data from the web, which I'm delighted is available in a simple command. So now I'll switch to another tool that I found useful, and that is which stock to sell or write calls against. So if you're like most people, you have a portfolio of stocks, you may be wondering, which stock is it time to sell, or can I safely write a call against? And I found myself going over and over to the CNN Financial Analyst page, which is a free resource, looking at the analyst median forecast and the high forecast, and trying to figure out, as I crossed over a couple of stocks, like which one is really sort of reached its maximum potential and maybe I should swap out. And I quickly realized after 3 or 4 stocks, you just can't keep this in your head. So I thought, hey, I can use some open source tools to get a better perspective. So in this case, I used Python or R to scrape the data and get the mean and the highest analyst estimate, and I plotted as a scatter plot. And so to just talk about this briefly, this one vertical line here is the mean, that's the percentage of the stock price versus its mean estimate. So every stock on the right-hand side of this is above the mean estimate of the analyst. And the higher you are on the scale here is the closer you are to the highest analyst predicted 1-year price. So in this case, this was done at the end of the year, so don't trade on this. FireEye and MGM were really at the top of the most optimistic analysts' forecast, and they were well above the mean analyst. So this gives you an indication of how your stocks in your portfolio, if you trust the analyst, which I think is a good way to get a second opinion, where those stocks were and what you might want to do with them. I'll give you another example here, switching to time series. And this is some housing trends and detrending some data. So seasonally adjusted is a term you often hear. So we'll look at some housing sales and housing sales of completed homes using R. So this data came from the US Census, and you can go to this URL here, and these slides will be available after. And you can select new home sales, single family homes, homes that are completed, and the time interval. And you get a nice time series. With a single command in R, we can chart that series. That's what we're showing here. And we can basically decompose it into the original series, the long-term trend, the cyclical seasonality part of this time series, and an error component. And so what this gives you is a nice smooth graph that tells you underneath all the wiggling that goes on seasonally, this is what's happening in the housing market. And I'll talk a little bit about this downturn that we saw. And if you're watching the news, this may not be a shocker, but what a difference 8 months in the supply chain issues make. So again, with a single line in R, which I'll show you in a second, we can take our series. In this case, the blue line represents all of the data we have. The green line is the interval over which I used an ARIMA model to predict the movement of the future housing prices. And so if we started in January, you see the prediction we would have received using that mathematical model. And you'll notice there was a huge deviation. And that was largely due to, remember this, we had supply chain issues, we had a massive spike in lumber and labor, all related to the pandemic and the reopening, and basically the unpreparedness the economy had for some of the growth it was experiencing. So if we move that forecast window out to August, you see we get a very different forecast here. So this is just kind of a buyer beware message about regime change and external exogenous events that might affect your forecast. But nevertheless, those great charts and the time series stuff is all done in R with a small number of lines of code. You see here, this is the CSV file that I pulled from the census data. We have the time series, we're charting it, the decomposition is here, it's easy to see. And the forecast using this ARIMA model is a simple one line, and then we can predict, we can tell it how many periods forward we want to predict. So there's a great article here for time series, and portions of this code came from here, so you can run this at home. And one other thing I want to talk about and just close out with here is how data science is providing edge and alternative data predicting stock prices is largely ignored by the market, at least as of an academic paper in 2018. This is the title of that paper, and I'll go through some of the findings briefly. So if you look at satellite data, it's a strong predictor by studying the parking lots. It's a strong predictor of same-store sales. And this data is available for purchase for the most part. But the interesting thing is this data is available all the time, and including prior to quarterly earnings announcements. And the market doesn't appear to reprice based on this data. And that was the purpose of the paper. In particular here, you remember Chipotle had this problem with some foodborne disease issues. And we're showing here the data in the black line is the change in the year-over-year car count. So there was a huge decline in the year-over-year car count. And if you look at the stock price here, it didn't move as much as it should on that data until we basically had these quarterly announcements where people realized what was going on. So the academic paper did an interesting thing. It looked at the satellite data for the companies that had satellite data available. They were basically buying this data from a service. And they split the stocks into quartiles. And so the top quartile portfolio held all the retailers who showed significant year-over-year growth in terms of parking lot occupancy, or fill rate is what they call it. And the lower quartile was the satellite data that showed a drop in the parking lot fill rates. And so their strategy that they applied in this academic paper was they looked at going 5 days before the earnings announcement, shorting the lower half with the falling rates of fill rate. In other words, less cars in the parking lot year over year, and going long the retailers that had an increase in the year over year parking lot fill. And doing this they found that they could get 4.6 to 4.7% of a return just on that data alone. And what's interesting about this is the analysts themselves, who were the ones that promoted using something like satellite field data, don't seem to adjust their pricing prior to these announcements. So this is an opportunity where you can use data, and people were to get a significant edge. So one parting thought I'll just mention here is the co-author of the study said, hey, isn't this insider information that everybody can count parking lot cars, but it's not a practical thing to do that on every store. And the seller of the data said, well, look, this data is expensive now, but soon will become cheaper. And so over time, everybody will get this data. Now, the interesting ethical question here is, and I think the panelists will pick this up in our next session, is what is the role of regulation in these areas where there's lots of the data available and you're seeing people get some edge? And with that, I'll close this out and we'll enter some question and answer period, and then we'll get ready for the panel coming up shortly. So Cordell or Lucas, any questions you wanted to answer initially, and then we can turn it over quickly to the panel?
The only question I saw in the chat was something about Morningstar. Why aren't I can't speak for Morningstar. So, you know, I don't know why. Look, this is something that I created. So, you know, I don't have an answer for that question.
Okay. And I think with that, we're about ready to start the panel. We'll take maybe a brief intermission, and I'll turn it over to Dr. Mahdavi.
Well, thank you very much, Don. Can you guys hear me?
Yes.
All right, everyone, really appreciate it. I mean, it was such an impressive session. I can't believe it. The three of you guys hit it out of the ballpark. I'm so impressed with you guys. So we are going to start our panel, and don't go away, because what we're going to do is we're going to take all of this that we have heard and we have seen, and we're going to put it in the format of talking between the industry leaders and where do we go with all this. So if you feel you need to take a couple of minutes break, do that, but please come back and listen to our all-star panel. Okay, well, let's get started, and if you can light up our panelists, we get started. So I thank you very much for everybody to hang around. I see a good number of people are hanging around, and they want to listen and hear from our industry panelists. Let me start by thanking Cordell, Lucas, and Don to show us some really interesting use cases and some powerful results. So in those sessions, what they showed is some of the important use cases and wide range of technical capabilities from data science and machine learning that you can use in asset management. For example, they showed the power of individual financial data scientists, which develop very important high impact application. They also demoed both open source tools and commercial platforms that require little or no coding. They also, in my opinion, they really showed the importance of combination of technologists and domain experts to make this thing work. One without the other is not going to work. So the bottom line is, learning from the last session, technically we are making good progress, resulting in new capabilities in asset management business. So for the panel, what we want to do, we want to look at this from a different lens. We want to look at all these developments and everything that's going on in data science, in asset management, from the viewpoint of the managers and the industry leaders. So that would be a kind of have a unique look at what this means from the management point of view. The panel format will be very interactive. And to start with, I would ask each one of the panelists to introduce themselves for a minute or two, and then we'll proceed with the Q&A segment. And that will take about 45 to 50 minutes. And then we will use the last 10 to 15 minutes answering your questions. And I've already seen some questions popping up, so it's a good start already. So now, without further ado, let's just start the intros. And I'm honored to have this distinguished panel. And let me start with Jane and ask Jane to get us started with introducing herself. Jane?
Thank you, Mirzad. My name is Jane Buchan, and I co-founded and then was the CEO for PAMCO, which I retired from 3 years ago to do my own little data science firm. But at PAMCO, we were the world's third largest fund of funds. So I peeked inside a lot of asset managers and seen what they do. In addition, I got my background and started at JP Morgan Investment Management and briefly was a professor for 3 years, tenure track professor at Tuck at Dartmouth. So I am a data scientist through and through and have done a lot of practical work with it.
Thank you, Jane. Appreciate it. And we are honored to have you today. Let's go to Ben. Ben, are you there?
I am. Can you hear me?
There you go. Good to see
Wonderful.
you.
Thank you very much. I should make a confession right from the start. I've listed the panelists. I'm not a quant by training, but somehow I ended up running a quant team, and somehow I ended up on this panel as well. So bear with me. But I might be, at least from a practical perspective, I can tell you how we've, taken a lot of these tools and we've been able to apply them pretty far and wide. So I run a team at Bank of America. It's called Solutions Oversight and Data Analytics. And if any of you follow acronyms, we benevolently call the team the SODA team. You can think of our team as a kind of a quantitative backbone or a piece of infrastructure for the chief investment office. So we largely support not only the product and platform teams across Merrill Lynch and the private bank, but we also support the due diligence teams, the portfolio construction teams, and the strategists and thought leadership teams as well. Essentially, we're trying to take our expertise in data, analytical modeling, and largely our experience working with managers and portfolios, and we try to make better decisions on behalf of our clients using these quantitative models and methodologies. It's somewhat of a newly creative team, but it's been a really fun few years building this out and trying to create some white space in what's a very, very large firm. So I hope that helps.
Excellent. Excellent. Thank you, Ben. And we are really glad to have you here today. George, would you take a few minutes and introduce yourself, please?
I'd be glad to. Thanks, Mirzad. I'm George Martin. I've spent about 25 years in quantitative finance, almost exclusively in an institutional context. Sort of the first half of my career was mostly focused in sort of hedge funds, derivatives, structured products, and then the second half in the private equity space. I've really seen a lot of changes. I was sort of impressed with one of the earlier speakers' discussions of using hierarchical clustering to do manager classification. I did that 20 years ago, but had to do it in much more painstaking fashion, coded in Fortran. So really excited to talk about sort of the state of data science, state of machine learning today.
Excellent, excellent. Thank you, George. And Mikael?
Hello, my name is Mikael Noguer Alonso. I'm the founder of the Artificial Intelligence Finance Institute. We offer boot camps and write a lot of research on deep learning, machine learning, reinforcement learning, NLP applied to finance. So all these topics that we're discussing, very exciting topics that we're discussing today. In addition to that, I teach at NYU Quran Institute of Mathematical Sciences. Before I was teaching at Columbia University. And before being engaged in the Institute, I worked for UBS for 10 years and a European bank for 10 years, always as a quant. And I've witnessed and somehow driven some of the changing tools and technologies that we're seeing these days. I'm very glad and honored to be here.
Well, thank you very much, Miguel. I must say, and I keep saying this, it's an honor to have such a distinguished panel here, and I think our audience will really appreciate having the four of you here and seeing your opinions and ideas going forward. So without further ado, let me ask the first question from Ben. And the question is, how is your business impacted by data science? Where does it give you an edge? And if you can give us an example of two that relates to that.
Yeah, it might actually be easier to answer the question, how doesn't it impact our business? It's literally changing everything right now. Maybe I can think of one example that maybe goes across a few different areas. I was sitting on a chairlift up in Maine, about to go skiing on New Year's Day. I got a call that says, hey, we've got a problem. There's all these new securities that Trump is going to be sanctioning. We need to make sure none of those ever get inside of our walls, because if that's the case, our clients are going to be stuck with them. What can we do? So this started a massive search on how are we going to figure this out. And by the way, it's not just specific securities, it's any commingled vehicles that actually hold those securities. So what can we figure out? So, something that, our team built just in a very, very short order is to start looking at every single holding of every single commingled investment, mutual fund, separate account, ETF, et cetera, closed-end funds, look at every single investment everywhere in the world every day. Is that something that we can do? And what I didn't think was possible. And that's something that we've started doing. So this is more of a compliance function where, we talk about big data, every single holding everywhere in the world that we're actually now able to kind of look at, scrutinize, et cetera. Yes, there's some delays on it, but you can look at, big populations just by looking at, these samples that are out there. And it's great. So now we have the ability to block securities before they get here. We have the ability to watch how the managers are actually working down positions, et cetera. That same model we're able to take and we can use in portfolio construction. Now we can look really inwardly at our own portfolios, our own model portfolios. In these cases, these portfolio managers' indexes don't talk to each other. There's no communication between them. So, at any particular point in time, it might look perfect. It's aligned to our asset allocation, our targets, et cetera. But the next day, it might be completely out of whack. And it's just because these managers do different things. So we've been able to, and this is something we haven't done yet, but this is something that we're working on right now. Can we create a sleeve that will actually either enhance certain aspects of that portfolio or, take away or reduce risk in certain areas of that portfolio without actually creating taxable events, selling out of portfolios and completely. So it allows us to, go that much further. You can take that same holdings model too and say, well, where is the world right now? And how are things changing? Can we take that model and say, okay, how is the world deploying cash right now? How are professional money managers doing that right now? Are there changes right now on, in what particular countries or cyclicals? What is getting more money? So we can use not only external data to get that, but we can also look at our advisor activity. We could look at portfolios that are managed proprietarily for us as well to give us an indication of kind of not just where the puck is, but where that puck is going. And maybe just the last area, which is a little bit different, but just in the due diligence side, we spend a lot of time with due diligence, and you've already heard from Cordell and some others just talking about the due diligence process and how these tools can kind of help there. But this whole classification, I think Cordell went through that, which was awesome. That's very much the same thought process we think through. How can we identify groups or clusters of managers that do similar things? Are these income-oriented managers? Are these GARP-oriented managers? What type of fixed income are they doing? So classification is definitely a big one there. Capacity modeling is something that I built many, many years ago, which is trying to figure out at what point each of these investment managers should be shutting down. And we analyze every single holding of all these managers. We make a lot of assumptions as far as how quickly to trade. And we have, with a high degree of accuracy, we've built this and modified over 15 years for every single mutual fund manager. At how much more runway do we have in these managers? If we're going to go overweight in emerging markets, for example, by 1-2%, how much runway is that going to eat of our existing managers, and what other managers should we be looking at in order to kind of take up that capacity going forward? So it really gives us a lot of insight and proactive intelligence on the market, but also just setting expectations on performance and risk. That's a big deal. And understanding when to not only to buy and when to sell managers, it can help to create those expectations if the types of environments managers do well. So hopefully that's just a hint, but let me know if there's anything else.
Thank you very much, Ben. That was really insightful. I'm wondering if there's any comments or anybody on the panel wants to challenge Ben on his comments or not. No, it looks like everybody's happy with what you said, Ben. So let me point the second question to Jane. And the question is, where is the sweet spot for data science in asset management? Is it the front office? Is it the middle office or back office, or none of the above? And I took a cue from Bill Kelly at the beginning of the call of our event when he said we need to tokenize, and then we can open a whole bunch of new capabilities in terms of T+1 or T+2 or whatever to T+ nanoseconds. So if you would enlighten us, Jane, about where do you think is the best spot at the moment and going forward?
Yeah, thank you, Mirzad. I don't think it's easy enough to think. It's difficult for me to come up with one best spot. What I think about there's three different areas when I think of data science, and I think it's helpful for me is: one, I think about techniques; two, I think about data; and three, I think about efficiencies. And on the techniques side, a lot of that is focused in the front office. There have always been quants. I mean, we've been doing ridge regressions for 20, 25 years. I mean, those are very standard. What you're seeing is some introduction of machine learning, but frankly, most of the managers, in my experience, are having a hard time raising money on that unless they're part of a bigger firm. And part of the reason is that institutional investors want to understand how variables affect things. That's very, very hard to do with machine learning. On the data side, as Bill mentioned in the start of the introduction, the use of alternative data sets. There's a lot of people using that. They're actually doing some, but they don't really think about it in data science in a different way. They don't think it's also quant, and whether it's using satellite data or other data, that's becoming very, very prevalent to help. And then finally, the big area, which is sort of the area that I think is not well discovered, is on the efficiency end. And there's two areas on the efficiency end. I'm seeing a tremendous use of natural language processing. So that's reading documents by very fundamental analysts. So if you asked if they're using data science, most of them would say no, but they're using a lot of NLP just to process the amount of documents, to find documents that are of interest. And I think that's almost becoming de rigueur in any very large, fundamentally based firm, is they're using a lot of that. We're also seeing a lot of some firms work on efficiencies in operations. If you look at the middle and the back office, there's not been a lot of improvement. There's been a lot talked about change, but the actual physical improvement hasn't really increased a lot. And so we're seeing firms that are trying to find clever ways of using data science and the principles of it to structure and store data. An easy example would be know your customer data in a way to get efficiencies in the back office so they can focus on the real issues. So I break it down into those three areas: technology, data, and efficiencies.
Excellent, excellent, yes. Any comment from the other panelists?
Just one other area I was just going to say, kind of looks like a sweet spot to me, is just efficiency in the due diligence space as well. Your aim is always to cover as few things as you possibly can, so you can cover them as deep as you possibly can. And one of the things that we've been doing, spend a lot of time with Anna Snyder, who runs the due diligence team, is on the closed-end fund side, we were in the process of really building a great model there, which is helping us to kind of give us confidence. What are the managers we should have some confidence in? So it helps to stack rank managers from kind of top to bottom. It also helps us to identify things that I think we might want to spend a little bit more time on. So it really helps us to focus our time on managers where there's kind of issues. And so yeah, just another area which we haven't seen a lot in other places, other firms that are doing a lot of this, but certainly comes to ETFs, closed-end funds, and eventually mutual funds. We're making a lot of headway there.
Excellent, excellent.
If I may, so when you start looking at asset management problems or banking problems, right? All of them have in common something in which you would say data science should be really useful, which is we have largely dimensional data sets. So we have many times lots of data, we have lots of features to look at, and we have regression, classification, right, and attribution problems. In all of them, right, obviously, machine learning is the answer, so to speak, or data science is the answer. Humans can no longer cope with many variables, cannot understand these large dimensional spaces. So when you look at, when all these large institutions start looking at these problems, they have to realize that's the way to go, right? Because the traditional tools, so to speak, which were, linear regressions and all that stuff, it's pretty limited to understand these large dimensional spaces. So I think that all companies, all asset managers should have now data science as a core skill, right? And if they don't have that, they will be missing some important boats.
Interesting, very interesting. So let me follow up on that, follow up on what Mikhail said and Jane mentioned, and also Ben, about use of data, basically, and some of the issues regarding the explainability of the data that seems to be a barrier, So following up on that, what I wanted to ask George is that, is better data always better? Is more data always better? And how do we manage the complexity of these models? And apparently explainability is a barrier, and how do we address that?
Yeah. Well, obviously a key question that follows on from some of the comments that my fellow panelists have made. So, the short answer is bigger data always better? Well, the answer is it depends. And in terms of sort of managing model complexity and other inefficiencies, I think the answer there, and I'll talk a little bit about it, is there are sort of evolving sort of best practices, particularly sort of under the rubric of what's called ML ops, or machine learning operations, which is a set of practices which sort of sit kind of at the intersection of data science and DevOps. And so organizations that have complicated modeling environments, active and sort of dynamic machine learning frameworks really need to sort of pay attention to the processes that are sort of used to both sort of develop models, monitor models, deploy models, all those things. The fortunate fact is that more and more folks are focusing on those questions. But to return to the first question, which is bigger data better? I think it's obviously part of the question is sort of how do you think about it in context? What is the context for that question? And so I think there are a number of kind of key things that need to be kind of kept in mind. One is, what are the models that you're using that data for? How big are those models? How complicated are those models? And in particular, what are some of the problems that are associated with solving those models? And really, you've sort of seen over the past 2 decades, and I speak a bit from personal experience, having been around, sort of an evolution in how sort of data size and sort of the particular types of models interact. And so back 20 years ago, big data could be implemented in models, but the nature of the models had to be such that the algorithms available could solve them. So it was largely limited to models that were what were referred to as convex. In other words, easy to solve, relatively easy to solve for algorithms, sort of relatively sort of well-known characteristics of what the solutions might be. So things like linear regressions, other types of models with quadratic loss functions, all were solvable using optimization tools for convex problems. As the 2000s sort of moved on, basically there's more and more development of tools to solve more complicated nonlinear models, non-convex models, but primarily non-convex models that could be essentially reformulated as convex models. So again, you saw that in the end of the 2000s. So things like recommender systems, those basically were systems that were non-convex but could be embedded in a convex context. The sort of 2010s really has been sort of in machine learning has been the explosion of much more complicated models that rely on or that have sort of non-convex characteristics. So one of the reasons that that people can fire up their TensorFlow and solve those problems quite quickly is because there's been both a development in the nature of the optimization algorithms that are efficient for solving those problems, as well as sort of research and understanding of what kinds of algorithms are sort of appropriate for those complicated models. And so as the algorithms have improved, as the computational power has improved, and I just make a sort of side comment. I think one of the unappreciated facts of history is that one of the reasons why we have such scale in machine learning is basically because we have this proliferation of GPU technology, which was really not developed for machine learning, but was basically developed for gaming. So the industry basically put $100 billion into developing sort of GPU chips, which the machine learning community was able to essentially take advantage of. So part of the acceleration has been, somewhat by accident. So, but with all that, I think the question is, nowadays, bigger data, is obviously much larger than what it was. It's associated with models that are much more complicated. They involve non-convexities. They involve other issues that, frankly, sort of challenge the conventional intuitions that one would have for sort of small sample statistics. Models don't always sort of behave the way that you would expect when you're operating in high dimensions. And so, I think one example of that is, for a lot of complicated models, particularly like deep learning models, what you end up with is this sort of prevalence of models that are what are called over-parameterized. So you have this more than growing data, what you have is sort of this growth in parameters. And so the question is, when folks are kind of evaluating the more data versus less data question, you really have to think about it in the context of how you're actually going to solve that model, how you're going to actually optimize that model. And so that, there are nuances, there are particular cases, but the usual sort of intuitions about that come from sort of small sample statistics or asymptotic statistics really don't always sort of hold true in the context of these much more high dimensional models. So that's the data question, and then the ML ops question. Again, I think there's sort of burgeoning set of tools that are available for folks to sort of manage model complexity. I think it's for the industry to really kind of figure out how to use those in context. I mean, it was great to see all these sort of wonderful examples in the earlier session about sort of very simple sort of do-at-home modeling, but when it comes to sort of deploying more complicated models in production, there are regulatory constraints, there are governance constraints, there are stakeholder constraints, there's auditing constraints. All those things need to be managed. And to the point of the earlier comments around efficiency, the great thing is that the tool sets to sort of manage all those dimensions are being developed, and sort of it's really a question of going out there and deploying them.
Sounds very good. Sounds very good. And I think your comment about the technology, the platforms are available. They've made a lot of progress, but there's a lot of governance issues. There's a lot of regulatory issues and scaling issues that needs to be resolved. And I bet you Lucas has some comments on those things. And when we get to it, he can talk about how they are trying to solve those kinds of problems on a platform,
sure,
from a platform standpoint. But very, very good point. Now, let me, given what you said on the coattail of what you said, let me point a question to Mikhail. I think George gave us a good example of how things have evolved over the years and going from statistics to and so on and so forth. Well, I wanted to get your feel for this because you've had a really particular leadership in this area, Mikhail, and maybe you can tell us how the field has matured.
Yeah, so another there are two perspectives, obviously, what the practitioners do, and the other is what do we teach, and what's the education, right, of finance experts, right? And it all goes in line with George mentioned. So I would say before 2015, 16, in all MFEs of the Masters in Financial Engineering in the States, we were teaching, right, traditional finance in the sense of linear factor models, option pricing, right, probability theory, statistics, and so on and so forth. Data science brought a different perspective in the sense of, we have many more tools that are less parametric than the ones that you've been using, but they can cope with different problems, right? They can cope with problems like data sets, right, or relationships between inputs and outputs that are nonlinear, super high dimensions, right? And the ability to perform unsupervised learning and all that stuff. So the idea is, right, we have, so data science brought to us a really different perspective. I wouldn't say not only in finance, but everywhere in which you had large data sets, right, and potentially non-linearities and so on, you should be using, right, data science / machine learning tools. So I taught the first data science in finance course back in 2017 at Columbia University. And at that time, we said, okay, we have to change the way we're teaching these, right? Because, you know, students only see some sort of a fraction of the things that they can be used, right? So, and at that time, we started teaching, obviously, alternative data, which was also, you know, started to emerge as very important at that time, 2016, right, maybe 17. So these alternative data sets started to be available, right? And they bring different problems, right? So they bring problems like sparsity and so on and so forth that data scientists and econometricians were not used to deal with. And again, the new technologies brought us more classification models. They certainly brought us larger models like deep learning models in either time series or cross-sectional data. And then we have two new things, so to speak, right, that really emerged 2 or 3 years ago, which is reinforcement learning and NLP, natural language processing. It's clear that natural language processing has been going hand in hand with because we've seen a huge development of tools for the last, I would say, 3 years, right? Because actually, right, BERT is actually 3 years old, right? So it's not that old, right? So NLP has brought really a new tool set, right, in order to address many, many problems. So we do think that, or I do think that NLP is going to have a really huge impact. And there's a lot of research coming, right? So we're working in something that we will release this week, right? That I hope you'll find interesting. But yeah, I think that in even mathematicians, right? This year I'm teaching mathematicians, and now mathematicians are finally embracing computers. They're saying, okay, there's a lot of problems we cannot solve with pencil and paper. There are actually lots of problems that are being solved by computers. We have to change a bit the way we look at our problems. So again, even mathematicians are realizing pencil and paper has its limitation. And again, I think it's a revolution that it really is changing all sciences and businesses.
Yeah, and just one thing on that too. I think, you know, on NLP, because I think it's a really good place to kind of jump in. And NLP, I think, hits so many areas across finance in general. You know, so in that case, it's like, no, we never had that ability to really gauge sentiment across thousands and thousands of different investments. Now we have the ability to do that. But the other huge part of that too is just scale. You can do so much with so much less right now. Your ability to go through, you know, thousands of earnings reports or, you know, tons and tons of sell-side research and be able to quantify it down to some very simple data points. And, you know, we will probably end up talking about this at some point too, but as far as democratizing data, that's definitely helps. Those are things in the past that only the Renaissances of the world or Two Sigmas of the world could do. And these are things that, again, a person with a computer with some knowledge and maybe a little bit of coding background can do this type of stuff now.
That's an excellent point. That's really excellent point. So, Ben, now that you have the podium, let me just follow up with you on a somewhat of a different question.
Mm-hmm.
Well, one of the questions we've had over time is for the industry leaders, for yourselves and the rest of the panel. How did you decide to enter the data science? They keep asking us this question. And what capabilities do you look for when hiring talent?
Yeah, I have to think the reason I got into this field is out of necessity more than anything. I mean, I think I really had to go down that route. But of course, I look back now and in hindsight, of course, I didn't have to go down that route. But, you know, I was in due diligence a long time ago. And I just feel like I get frustrated in the due diligence side of the business because there's just so much bias. And, at that point in time, all I cared about was the 50 things that I covered. The fewer things you cover, the better, because you can go deeper on them. But I cared about those things that, that I covered. And when you look at other people present, they bring things to committee, you just realize that there's just way too much bias in the process. And this bias ultimately ends up in client portfolios. So, at first, I just like to kind of silently blame others for this. And then I realized the further I got into it, I was just as guilty as everybody else in it. But, who did I last meet with? Did they approach me or did I approach them? Or what styles do I like more than others? I had this way of always trying to pick more complex managers, and I thought more complex managers were always better than simple managers, which was almost never the case. Not never, but oftentimes wasn't the case. So these predispositions of even the worst, or who are the managers that actually presented best? All of this stuff just made me feel like what I was doing was kind of chaotic. And I think out of a result of that, I think I turned to quant. I don't know if you want to call it the dark side, but I kind of turned to quant because it just felt much more scalable to me. Number one, it was much more scalable. Number two, I think it just helped to remove a lot of emotion and behavioral biases in general out of the whole process. So I could kind of create these consistent yardsticks, and I can constantly measure things against them. And that just made me feel like I had so much more objectivity rather than subjectivity. Subjectivity has a place there without a doubt, but it was a very, very important part there. So if I kind of fast forward that to, when I was given the opportunity to oversee the whole platform for US Trust, which is now called the private bank, I can apply it much more broadly. So again, in the past, I'd cover 50 things. Now I'm covering 500 things. And I really wasn't willing to let those biases that I knew exist to kind of really permeate into ultimately into our client portfolios, especially some of the wealthiest clients at the bank as well. So I was able to take that time to really fine tune those models and then really, really scale them out. And once you start talking about scaling, then you're really into tech, then you're into data science. How do I take, again, it's easy to do, attribution reports on 5 managers. It's harder to do it on 50. It's very hard to do it on 500. And that even got bigger when I had the opportunity to start doing this across the entire bank, including Merrill Lynch. So, in short, if I have to kind of think about it, it was much more of an evolution than a revolution. As far as how I hired, I think that's changed a bunch too. I think there's a practice that all quants, maybe just all people in general, have is the would I have a beer with them test. It seems kind of funny, but at the same sense, it's actually really important. It spoke a lot to character, and I spent so much time in front of my screens and with these people. Do I want to spend time with this person? And that's a really important thing, and making sure that we get the culture right and that this person fits in is extremely important. I think that really morphed into just diversity in general, though. If you're looking at a particular object on a table, I can see what that looks like from here, but I can't see the other sides of it. So we realized more and more that the more that I could diversify by gender, diversify by background, diversify by personality types, we ended up just getting such different conversations. And the more and more, the better that conversation got, the better the decisions that we made. People were always not afraid to kind of speak their minds and add their own comments. So that's really helped us a lot. Now, obviously, there's hard skills too. We talk a lot about R, and we talked a lot about Python. We primarily use R on our side, but it's learnable. If you know Python, you know other stuff, you can get into it. Not everybody on my team knows how to code. We use a lot of software that doesn't require it too. Stuff like Alteryx, which is a great tool that allows you to do a lot of data manipulation and modeling. And a lot of people have been learning SQL just because they've kind of had to. But these are people that, again, like me, didn't grow up coding. They grew up knowing managers, living, eating and breathing managers, and reading, Peter Lynch books. But they have kind of evolved over time. And you spend a good year in it, you start to pick up the stuff pretty quickly too. So hard skills are important, and I do like to get a lot of the coders right out of school so they're not nearly as biased. Hopefully I can unplug some stuff they learn in academia, but not everything anyway. So
very good, very good. I think you mentioned. Well, you mentioned something that I wanted to follow up with Jane. I think, and following on the same direction, the whole thing about what do you look for when you're hiring, and you brought in the dimension of diversity. And I know Jane is a real champion of diversity. So I wanted to ask Jane to sort of talk to us a little bit about that, and how does that fold into building a team, basically?
So it's really important, when you think about this area, for, I don't know, 34, I've been in this industry for 35 years. Ever since my beginning in the industry, I've noticed, there have been people who have been trained as, a lot of astrophysicists because they dealt with a lot with empirical data and data sets, kind of try to cross the bridge. In fact, you've established a lot of these masters in financial engineering programs to help them cross the bridge originally. That's why they were put in place. It's great to have diversity of thought and people who are really technically trained, but I think you have to also remember that these markets are more in terms of they're not stable physiological hard systems. And so, for example, while you've seen tremendous progress in some of the sciences for analyzing large data sets, you get a lot of unpredictability here. For example, COVID, your data set doesn't work during COVID. And what do you have to do to transform things? And how do you update data? And how do you make judgments? So, and if you read the histories of asset management firms, you'll notice this theme. I mean, I think there's a well-regarded story about, when Renaissance was having some trouble, do you pull the plug because you don't understand what's going on or not, and all the debates. And I think there's other very large prominent firms that kind of fit in that same category. So I think you have to think about, you need people from all different backgrounds. So in addition to the data sciences, some of the more valuable questions and some of the things that have really impressed me over the years in terms of managers I've hired and also work we've done are the really basic, back to basic questions. Like, this doesn't make sense to me, or how do you handle this? And let me give you a very concrete example. Occasionally you have companies that pay special dividends and they use the dividend mechanism to distribute proceeds from a sale. So it's a special dividend. I rarely see a manager that handles that well, that realizes it's an idiosyncratic one-off, that it's not just an observation and modifies the probability distribution or something else with that. And things like that, making that judgment to know it's not really an anomaly or an error in the data set, but it's a one-off, and should it be included or not included when you're modeling things. And this whole point of judgment and asking the very basic questions is really important. So I think when you build a really strong, cohesive team, it's really important to keep an open dialogue, to let people who both speak a practical language to make sure that they fully explain themselves to the data scientists, and conversely, that the data scientists don't so drop into nomenclature that they crowd out some really important basic questions. And I think being open to all these perspectives is super important here, because it's very easy to get one or two personalities that dominate. And then invariably, every asset manager, the wheels at some point start to run a little bit off the truck. And the good managers have very strong cultures and systems to question everything and get everything back on process. The weak ones I've seen, by and large in my experience, are ones where you don't permit that diversity of opinion of what could be going on. So I think it's really critical.
Excellent, Jane. Excellent. Thank you. So I had more questions, but I think we are running out of time, and I see the questions from audience rolling in, and there are some good questions there. So let me ask you, let's, in a lightning round mode, ask each one of you, I ask a question, and if you could answer it quickly or briefly, that would be really nice. So number one, first lightning round question: what development in the field are you most excited about? Let's just start with George.
Actually, the ML ops piece, further practices designed to sort of smooth the sort of management and engineering of ML.
ML, okay, great. Ben?
Yeah, I just this whole assisted modeling stuff is just amazing because there's a lot of those guardrails. Again, I'm not classically trained quant, so I love that analogy of Wii bowling. I need someone to show me what some of those bumpers are. And yes, I've got a lot of people that are a heck of a lot smarter than I am on my team that know some of that stuff. But having that assisted modeling, and not only that, but especially working for a big bank too, being able to have it tie back into what does this mean, what happened, what were the assumptions in it, and the documentation associated with that. It just makes the process so much easier. So I'm very thankful for that.
Excellent. Jane?
I'm very excited about making it more widely available. I mean, there's a lot of bleeding edging techniques, but the reality is, I think having just a basic level of data science is going to be important across the entire toolkit, whether you're a fundamental analyst or you work in operations.
Excellent. Mikhail?
Yeah, so things that are obviously very hot right now have been mentioned already, but I would say NLP is obviously something, again, that really shows a lot of promise, reinforcement learning. And in order to some sort of convince or regulators and skeptics, obviously, interpretability is something we're investing a lot of time, So I guess that you build a model and you choose one, and then you end up, spending more time on the interpretation, or of the deep black boxing of this particular model, And it's amazing because you end up using more machine learning tools, Because you actually use the trees and you actually use linear regressions and so on to some sort of build interpretability tools for the larger models, and then you can combine them. So I think, and let me and one final thing, I think we are very excited about synthetic data. For the first time in my career, I see that there's a real interest on saying, okay, historical data sets are not enough. We need more. And that happens in lots of contexts and domains. Historical data is not enough. What can we do to some sort of create some sort of synthetic data sets, but at the same time, they're obviously plausible, realistic, and so on, that can help us, then with algorithms and more knowledge. I think this is a critical aspect for many problems. So think about the autonomous cars. So for autonomous cars, you need even more data than all the cars in the planet. So and machine learners are inventing new ways to generate some sort of more data for autonomous cars. For markets, we need a similar thing.
Great. I got one more lightning round question, and please do a brief one so that at least we can get to one question from the audience. Biggest challenge, George?
Just people, human capital, getting the right people. I mean, there's far more to be done than there is people to do it. So just getting good people.
Ben?
Yeah, I'll just take the kind of the stance of, look, I work for a very, very big bank. I think 1 out of every 2 or 1 out of every 3 people in the bank, 1 out of 2 or 1 out of every 3 Americans have some relationship with the bank. So we don't move, that quickly, but there's definitely areas within the bank that move quicker than others. So, just trying to navigate that, working with model risk management, work with compliance, getting all these things together. And I think ultimately just being an agent of change is a full-time job in itself. So yeah, those are my hardest parts. Is kind of partly that is just dealing with people and how to manage those processes.
Got it. Jane?
I just want to second what Ben said. I think communication and management skills are really important. We can all think of data science projects. I know lots of managers who have hired people, spent millions of dollars, and then thrown up their hands in frustration. And I think it's because they didn't understand what they were trying to do at the start.
Got it. Mika?
Yeah, I think obviously, as we said, the critical aspect is integrating a team of domain experts and data scientists. I think finally, no data science project is successful unless it mixes up well domain experts and data scientists, I think this is a critical issue. The second, obviously, is keeping the pace. So there's a lot of things going on. This is an arms race. So you're competing with other people that tries to create alpha. right? So you have to keep the pace of experimenting, innovating, trying to find new data sets, trying to find new algorithms.
Great, great. Well, thank you very much, panel. Really appreciate it. I was looking at the Q&A sessions, and the one thing that I see a lot of is people really are thankful to the four of you guys. Everybody is talking about what an informative panel, and they learned a lot from the four of you guys. So I really appreciate that. And in fact, one thing was there are people from India that are listening to this, and it's very late for them, but they're still staying and listening to you. That I think says a lot by itself. Let me ask Don Hejna, are you there?
I'm here.
Okay, I think we can have one question left. And so if you had to pick one question, would you pick one, and then we will pose it to whoever that wants to respond to it?
Okay, yeah, and if it's quick enough, maybe we'll get both. One interesting one was for the IT people that support the CFAs. What's an appropriate innovation budget for the data, and how the IT team should be prepared to support that?
That's a good one. Yes. Anybody wants to respond to that?
I don't have a good, the way people bucket things is always a little bit different. So I have to be kind of careful around budgeting, but you just remember you need to have a data budget, and then you have to have a technology budget, and then you have to have an implementation budget. All three of those are very, very different things. The data is so expensive. A lot of the stuff that we use, and kind of speaking to that kind of gap that between everyday people and institutional investors, that data is a lot of money. Depending on the size of your bank or the firm that you work for, the IT costs can be expensive, but it doesn't have to be expensive. And then again, the tools are probably the best part. A lot of these tools you can get actually very, very inexpensively, but you can get into the much more expensive stuff, the data robots and some of the other stuff that's out there as well. So it's hard to say. It just depends on, go for as much as you can get, and then, work down from there.
Very good. Very good point. All right. Any other comment from the other panelists on the budget side, or how big or small of a team? Okay, very good. Don, do we have anything else that you can pick out, or should we close the panel session?
Well, there was one interesting follow-up to that. It was just that somebody said, and I think it's an interesting challenge for the group, if somebody wants to take it. They said they don't agree with the data science democratizing data. Because it takes a team of PhDs and data scientists and AI experts. And they said they may be better to just buy the data for anything between $4 and $100K a year. Any counter arguments welcome. I think it's an interesting question about the premium that will always be there for valuable data.
Yeah, so definitely kind of appreciate different points of view on that as well. But I just think that anything you can buy publicly for that, eventually that's going to get arbitraged away. And look, that might work for a little while, but it probably won't work forever. So my point on that is that what you can do a heck of a lot more than you ever could have in the past. And there's still a lot of, we just saw that in some of the data points there too. Some stuff takes a while for it to actually work. So you might have a model that you can develop that will actually work pretty well, at least for a little bit of time. But you just have to realize at some point it is going to kind of diminish over time too. So I don't know. I can see both sides of it, and I kind of do play both sides of it as well. But yeah,
I think we can say that some of the tools, some of the best tools are democratized. So you can actually run, right. So algorithms are, as Ben was saying, are cheap, right. Data that it's costly to produce. You have satellites out there, you have algorithms reading, and so on. It's obviously expensive too for the one who generates the data set, but eventually also its value is gonna diminish over time. So I think that and in addition to that, you have lots of questions. Portfolio managers have lots of questions to be asked and to be answered. Like, for example, in the COVID era, all was questions. So also data scientists, in order to some sort of fine tune the algorithms, were also trying to get more data web scraping, and so on and so forth. So I think this is a really part of the art of this is combining the money you have and the data and the resources, right? It's always a bit the same, right? So you can opt to have 100 portfolio managers or maybe 10 with more tools. It really depends on the problem you're trying to solve.
Yeah, I mean, there's so hundreds and thousands of managers out that are still reading investment reports to this day. They literally are reading investment reports to this day. You can have one person that goes through thousands of them at the exact same time and probably get the same amount of data from that. So that to me feels a little bit like democratizing.
Mhm. That's correct. Well, I think we have run a few minutes over time, so I don't want to keep our people from India up that much longer. So I'd like to thank very much our esteemed colleagues here on the panel. It's been a great 2-hour session, and at this point, I'd like to turn it over to Mark Salter, the CFA Minnesota Executive Director, to close the session. Thank you very much. Mark?
And all I will do is to repeat what has already been said. Thank you, panelists. Both sessions, first and second session, this was really, really good stuff. And the chat bears that out. People are saying, thanks, great webinar. Not a techie, but I learned a lot. So we really appreciate all of you taking time out to help us get smarter about data science and asset management. So with that, I turn the rest of your day or night back to you, and we'll see you at a future event. Thank you again very much.